Hey everyone! In today's lesson, we'll cover some basic and commonly used terminology in trading. Understanding these terms will be very helpful, as we'll use them frequently in future videos. Let's get started. Whenever we watch CNBC or any other financial news channel, I am sure you have heard terms like bull and bear markets. These terms describe current market conditions. For example, bull markets occur when major indices are trending higher and consistently breaking all-time high records. In recent years, we experienced a bull market that lasted for a long time, marking an impressively long bullish run for stocks. In contrast, bear markets refer to periods when the markets are in a downtrend, with major indices continuously declining in price. It is generally accepted among the investing crowd that bear markets usually start when the S&P 500 drops 20% or more, and there is no solid evidence that bulls are fighting to reverse the price. In many instances, in a downtrend, prices occasionally bounce back. But at the end of the day, bears usually win. The individuals who engage in buying and selling are referred to as bulls and bears. Bulls drive markets upward and help sustain bullish momentum. They buy assets when prices are low and sell them at a profit once prices increase. The strategy is simple: buy low and sell high. The act of buying stocks is referred to as going long or being long. So, if someone asks you if you are long the market, they want to know if you have purchased stocks. On the other hand, individuals who sell stocks to profit from price declines are called bears. They sell stocks at a higher price and then buy them back at a lower price, profiting from the difference. The practice of selling borrowed shares with the intention of buying them back in the future is known as shorting or going short. However, if traders are simply selling their shares to capture profits during a bull market run, this action is not considered shorting. Another interesting term used in trading is volatility. Volatility refers to the degree and speed at which prices change over a period of time. It is closely linked to the fear present in the markets. When people are apprehensive about uncertainty, volatility tends to be higher. This often occurs during bear markets and sometimes during mild pullbacks in bull markets. Conversely, when there is a strong bull market, volatility is generally lower. Don't worry, we will explore these topics in more detail in future lessons. So, what can happen when volatility is high? While high volatility can be advantageous for day traders seeking quick opportunities, it often prompts caution among most traders and investors. Many traders may find themselves frequently stopped out of their positions, and long-term investors often face a turbulent market that can adversely impact their portfolios. As a result, brokerages might raise the margin requirements for client accounts, further diminishing the profit-making potential for traders. Additionally, the premiums on options usually increase, which can either greatly benefit market participants depending on their positions or lead to significant losses. If volatility is low, the opposite is usually true. This often occurs during bull markets, where the level of fear tends to be lower. To illustrate this, refer to the two slides on the right. The first slide depicts a healthy bull market with lower volatility and overall investor happiness. In contrast, the second slide shows a strong bear market. Here, volatility is relatively high, and panicked reactions are evident, resulting in significant price swings. I hope this helps you understand that analyzing volatility can help us gauge the level of fear in the markets. Now let's discuss margin. This topic can be confusing and complicated for beginners, so I will briefly explain it to provide a basic understanding. Margin trading refers to the practice of purchasing a stock or another security using borrowed money from a brokerage. It's important to note that the borrowed funds must be repaid in the future, along with interest. So, why do this? Traders may choose to borrow money because they believe it will help them enhance their returns by using additional capital. This strategy can make sense when they anticipate making a profit that outweighs the cost of borrowing. Consider this, for example. John has $10,000 in his account and decides to buy a stock for $50 per share. With this amount of money, he can purchase 200 shares. Let's assume that the stock price increased and is now valued at $62 per share, resulting in a $12 increase. John is pleased because he has made a profit of $2,400 from this trade, which reflects a healthy gain of 24%. Using a margin account, John's purchasing power can double, allowing him to buy 400 shares instead of just 200. This time, he would realize a profit of $4,800. Since he borrowed an additional $10,000 from his brokerage, he will need to pay interest at a rate of 10%. However, even after accounting for the interest, he still makes a significantly higher profit compared to trading without a margin account. This is a very basic example, but I hope it helps you understand the concept better now. While margin accounts offer a potential for higher rewards, they also come with significant risks due to the use of borrowed money. Margin trading amplifies both profits and losses, functioning like a double-edged sword. Additionally, brokers may close positions without the trader's knowledge if losses become too large and threaten to exceed the client's current equity. Using margin comes with a significant increase in responsibility. Unforeseen events can lead to sudden market shocks, causing prices to plummet the next morning. This can result in substantial losses for both investors and traders. When trading on margin, the risk of losing more money than the initial deposit is very real. For those who find themselves in this situation, it's unfortunate because brokerages can pursue their assets and other possessions to recover those losses. In 2015, a similar situation occurred when the Swiss franc rose sharply overnight, leading to significant losses for many investors and FX brokers. While such events are rare, traders and investors should always be prepared for the possibility of these sudden market changes. At this point, you likely understand that trading on margin without proper market knowledge can lead to disastrous outcomes. On a positive note, if individuals take the time to learn how to use margin correctly, it can be one of the most effective tools for enhancing trading performance. In some cases, having a margin account is necessary to initiate a trade. For example, to short a stock, you must have a margin account. Next in line, indicators. Indicators are additional tools that traders can use to enhance their analysis. They can be beneficial in identifying potential trade setups. However, it's important to remember that indicators are lagging instruments, so they should only be used as supplementary tools. The primary metric that traders should rely on is price. Ideally, the best approach is to combine one or two indicators with price analysis for optimal results. Here are some examples of commonly used indicators in trading. Volume. This indicator shows the number of shares bought and sold in a particular trading instrument. It allows traders to visually assess the level of participation in a specific market. For instance, we can analyze the volume on an Apple stock chart. Moving average. This indicator helps traders determine whether a market is trending upward, downward, or sideways. Stochastics. This tool assists traders in identifying whether a market is in an overbought or oversold condition. Relative Strength Index. The RSI shows the relative strength of a particular market. This helps traders avoid going against the trend and encourages them to follow it instead. I hope this gives you a clear understanding of how some of these indicators can help you and how they can be utilized in trading. During our discussion, some of you might be curious about where these transactions or trades take place, specifically regarding buying and selling. They typically occur on various market exchanges. An exchange is a marketplace where different types of securities are traded. These include stocks, currencies, etc. Even governments use it as a platform to engage with public investors. The most commonly known exchanges in the US are the New York Stock Exchange, NASDAQ, the Chicago Mercantile Exchange, and the Chicago Board Options Exchange. There are other major foreign exchanges that operate in different countries, such as the London Stock Exchange, the Shanghai Stock Exchange, and more. Have you ever wondered which country has the largest stock exchange in the world? It is the US. The New York Stock Exchange is the largest in the world, followed by NASDAQ. No wonder so much capital is regularly invested in US assets. Most people cannot operate on exchanges and trade directly with others. Instead, they rely on brokerage services to make trades. In simple terms, brokerages are companies that facilitate buying and selling assets on their clients' behalf. For example, if I wanted to purchase shares of Apple, I would use my brokerage firm to facilitate the transaction. Many firms provide platforms to trade stocks, options, forex, and other exotic instruments. Once you open an account and invest in a company stock, you are now officially building up your portfolio. A portfolio is a collection of various financial instruments an individual has purchased. These instruments can include stocks, bonds, currencies, derivatives, and more. Certain assets, such as bonds, offer interest payments and serve as a safety net during turbulent market conditions. Safe haven assets like treasury bonds, gold, the US dollar, the Japanese yen, certificates of deposit, and savings accounts should be considered for inclusion in a portfolio during specific times of uncertainty. For instance, a bear market is an ideal situation where these types of securities can provide safety and stability. It is essential to continuously adjust the ratio of safe and risky assets based on market conditions. For example, holding on to safe assets is generally less profitable in a bull market. Therefore, it is advisable to focus on risky assets like stocks, exchange-traded funds, cryptocurrencies, or currencies such as the euro or Australian dollar as the majority of portfolio holdings to maximize profits in bull markets. The type of portfolio traders should create depends on their risk tolerance. Bonds can make up the majority of the portfolio for more conservative investors. On the other hand, those who are comfortable with higher risks might include stocks and more volatile assets, such as cryptocurrencies, in their portfolios. If you're interested, I can provide more detailed information on these topics in a separate video. In summary, a portfolio should consist primarily of risky assets during bull markets and shift to safe haven assets during bear markets. I hope you found today's video interesting and informative. In the next video, I will explore candlesticks and charts in greater detail. If you enjoyed the video, don't forget to subscribe, and I'll see you next time.